A well-established precious metals company is diversifying in oil and gas. Why? Well, we're here with David Harquail, CEO of Franco, Nevada, at Gold Stock Analyst Day in sunny Florida. David, nice to speak with you again.
It's a pleasure to be here. It's always beautiful.
So I think you announced this back in November that the company was planning to diversify in oil and gas. Now, is this just a hedge against the volatility of precious metals? Why the move?
No, it's just a question of where the best value is in the marketplace. So we've just come through 2.5 years of deploying over $2 billion of capital, and we've done the Antamina deal, the Antapaccay deal. We invested in Candelaria. We've been funding Cobre Panama. So we've had this huge boost in terms of our gold and silver assets. And it was great because it was a buyer's market. All these larger companies were in trouble. And what has happened now is everyone's making money again, and the equity markets have opened up. So it's now harder to get good value by doing gold and silver deals. So we're going to where we think there's better value while we're waiting for our time to invest. So we're just trying to invest countercyclically.
So now, is it about 23% of your projects are focused on oil and gas?
No, we only about 5% of our revenues are non-precious metals. So we're still doing 95% of revenues from gold, silver, and platinum metals. And we say, in our mandate, we say we can do up to 20% non-precious. So we've built up our precious so much that we've got now the flexibility we can do any commodity we want. So I'm sitting there saying, why are we going to compete with the banks that are doing private placements and bought deals? That's the cheapest money for the companies. We're going to go now look at where our money will give us a better return.
So with that wiggle room, where would you look? Uranium?
Well, we would look at uranium. It's just that what happens is where we can do best is where there's lots of investment opportunities. And what we like about the gold and oil and gas sectors is there's lots of big companies, mid-tier companies, and junior companies, and everybody's chomping at the bit to try to develop their projects. Trouble when you get into uranium, base metal projects, and bulk commodities. And I used to run a base metal company, base metal royalty company called Redstone back in the 80s and 90s. Is that you can make good royalty acquisitions, but the business moves so bloody slowly. It takes decades for them to decide to go forward on a project, and there's so few players that the investment opportunities tend to be limited. The big guys don't need your money, and there's not that many junior players to look at for opportunities. So we tend to like places where there's lots of investment opportunities, and you pick the best ones within them. In my mind, you've got to look at 20 things before you find one thing that's investable. There's not that many opportunities in diamonds or uranium. That I think there'll be the odd place for us to go, but I can't grow a business.
Now you do get other risks in oil and gas that you wouldn't get in precious metals. So what are some of the differences that you're noticing, and how do you mitigate these risks?
The huge difference is in mining, once they build a mill, you know what that throughput is going to be forever. They're always going to maximize that. With oil and gas, the big difference is that they have to continue to put in capital to put new wells in. And so if the oil price goes down, you might see a production fall off if they don't put in the follow-up wells and development. So you have more of a production profile risk, which means you have to focus on what are the highest IRR basins for the individual operators, because those will be the ones that they'll always deploy capital at, while the ones that have a lower IRR are the ones that they're going to defer spending their capital. So this is why we've always done our oil and gas. We've been in oil and gas for 24 years in our company, but we've always done it in Western Canada because we said, we're a small player and there's lots of investment opportunities for us there. What we're finding right now in Canada is the differentials are blowing out. It's $15 a barrel, to get your oil into a pipeline in the U.S. You're getting a carbon tax now put on by our friendly, lovable new Prime Minister Pierre Trudeau, and Trump's talking about an export tax, for commodities coming into the U.S. And so you're saying this is a risky place to put capital. So we're better to go to invest someplace now that has none of those risks. And that's why we've been looking in Oklahoma and Texas, as we have none of those risks.
And you meant Justin Trudeau, not his dad, right?
Justin Trudeau, sorry. I'm still old enough, I remember his dad, yes.
Let's get back, just talk about precious metals for a second here, David. Do you still have room to grow these projects here?
In terms of the existing portfolio is going to grow by itself. We've got the expansions happening at Tasiast. Newmont's going to announce an expansion at Ahafo, Subika, later this year. We've got all kinds of capital. We have a slide there that shows about 35 different projects where they're adding new ounces. They've got their permits. They're going forward. So we got organic growth in our portfolio regardless.
David, I love asking you to gauge the sentiment of the precious metals industry. You always give me a nice, raw, honest answer. You feeling better this year?
Well, the precious metal industry, it's, I'm going to this big conference in the next few days. It's very upbeat. And I think there's a lot of people now that want to put money in the sector. And I don't like that because that means I have to compete with that particular money. So I'm sitting there saying, geez, I know it's not always going to be like this, so I can bide my time. And the nice thing with my portfolio, I'm the biggest dividend payer in the global gold industry right now. We paid $157 million last year from our company. And so we're bigger than a Newmont or Barrick or Goldcorp in terms of paying dividends. And I can pay that dividend for the next 30 plus years, just from what I have in the pipeline right now. So I can sit there saying, I don't have to chase anything right now. I'm just going to wait for those real windows of opportunity, and I think that's how you build a great company.
David Harquail, the most generous man in the industry. Thanks so much for joining us.
My pleasure, thank you.
And thanks for watching our coverage. We'll have more for you from Gold Stock Analyst Day here in Florida.